What stocks am I buying in February of 2025? In this video, I'm going to be sharing with you exactly this in a tier system format. Before we do get into this video, I would just like to say I'm not a financial advisor. This is just off of my own research. There is, of course, other stocks in which are very good to buy at this time, but these are just my personal recommendations. I have done videos going deep into most of these stocks now, and if you do want to see what my in-depth analysis of these stocks are, please do visit my channel. So let's kick this off with Alibaba. So I want to keep this as brief as possible for all of these stocks as there is a lot of them to get through, so I'm just going to use the intrinsic value for most of these stocks. Alibaba does actually have a lot of geopolitical issues at the moment, especially with the likes of Donald Trump getting into office. It will definitely have an impact on their performance. I know that they don't specifically carry out work within the United States, but tariffs will definitely affect Alibaba. So for that geopolitical tension reasoning, I won't be putting this at a buy. And to further back this up, we have Graham's intrinsic value here. On the left, we have the bullish variant, which gives us an acceptable buy price at $112, with the current price being at $89 and the intrinsic value being put at $149. This is showing that it is actually undervalued. However, if we move to the revised more bearish, on the right here, we can see an intrinsic value of 86 with an acceptable buy price at 65, putting it at a sell. If we get the mean of these, it gives us an acceptable buy price of 88 with an intrinsic value of 118. So with that being said, let's move back over to the tier list. So for me, this stock is relatively close to being in buy. However, I would be putting it in hold at this point. It is a high hold. In fact, I would potentially even be leaning to put it into a buy. With it currently being in a long position on the 15-minute chart, let's just check what it is on a daily chart. We are currently seeing it at a short position, and this could be looking to be reversed shortly. But for now, for February, I will definitely be keeping this at a hold. I don't think it warrants a buy currently. So now we're going to be looking at Google. Google has a P/E ratio of 26.52 and an earnings per share of 7.55. With an expected growth rate here of 12.41, let's see what my system says about this stock. So Google looks to be fairly valued as well, currently with the intrinsic value on the left being set at $268 and the current price being at $200. This gives us an acceptable buy price with a margin of safety of 75 at $201, which is just barely above where we currently are. If we look on the right here, the acceptable buy price is 124. Taking the average of this, we've got 162, with the mean intrinsic value being at 216. This stock currently looks fairly valued with future growth taken into account. So for that reason, I'm going to be putting Google at a buy. This is just mostly because of how safe Google is as an investment. If we compare Alibaba to Google, they are in very similar situations in intrinsic value terms. However, just because I think Google is a more rounded and safe investment, I will be putting that way above Alibaba, as it is one of the big US tech stocks. So for me, Google is definitely a good stock if you're looking to hold it long term. However, there is definitely better options if you are looking to see larger returns. So now moving on to another decent stock. Here we have Hims & Hers. So Hims & Hers is currently trading at 70 times on the PE ratio with an earnings per share of 0.44. Now this is where it gets a bit weird for Hims & Hers. So analysts are actually projecting a growth rate of only 12.64 in the next year, which I've said in previous videos I think is really underdoing what this stock is capable of. I've actually put this at 77 going based off of their previous earnings reports. So when we move on to my system, what does it say for this stock? So if we do put the 77% growth rate year over year in for Hims & Hers, this gives us an intrinsic value at $65 on the left and $33 on the right, with an acceptable buy price on the left being $49 and on the right being $25. We can see a mean here of $37, which is currently above where we are. So for me, it is a buy. However, this is depending on how good the returns are for Hims & Hers on their growth rate year over year. Obviously, I have made this 77% up just off of their previous earning reports, but analysts are actually projecting this to be way lower. If we do actually put in the analyst expectations of 12.63, then we do actually see the stock is massively overvalued at the moment. Again, I don't think this is fair for Hims & Hers, but the 77 could also be massively overvalued. So for that reason, let's move back to the tier list and see where I put this. So for me, this stock is definitely something to question. It's between a hold and a buy for me currently, but I will be putting it at the back end of a buy. It all depends on where we see the next earnings report go. In my opinion, I think it is going to be a good earnings report, but just purely off of speculation, I'm going to put it at the low end of a buy. I do think this is going to be a good stock, but of course, with the P ratio being really high at the moment, it's hard to say. It's definitely not a strong buy. It's in between a hold and a buy, in my opinion. So the next stock is Celsius. Celsius has been massively down from its peak in early 2024 with a PE ratio at 35 and an earnings per share of 0.72. Celsius could see a large amount of growth in the next year as they are expected to expand into broader markets. Looking at the analysis for Celsius on the next year's growth, we can see a 36.85%, which is obviously massively high and could prove reasoning for the P ratio being at 35.79. So let's just see where this stock currently is on an intrinsic value. So looking at the intrinsic value for Celsius here, we can see on the left we've got an intrinsic value of $54 and an acceptable buy price at 40, with the current price being at 25. This is obviously pricing it in at a buy. On the right, we've got an intrinsic value of 28 and an acceptable buy price at 21. Going in between both of these, we've got the mean of an acceptable buy price of 31 and an intrinsic value of 41, these both being above the current price. So it is proving to be a stock which could have massive returns in 2025. So for that reason, I'm going to be putting Celsius at a strong buy. I would just like to reiterate that strong buy doesn't mean go buy it right now. It just means, in my opinion, it's looking like it could see good returns in 2025. It's not going to suddenly jump up to the moon the second you put money in it at all. It could definitely even go down from here. But in the long run, I do think Celsius is going to be a good stock for 2025 and beyond. So now we're going to be taking a look at SOFI. So SOFI is at 149 times earnings currently, with an earnings per share of 0.12. Obviously, this isn't the peak for SOFI, as in October of 2022, we were roughly around the peak. So currently we're at $17.92. What do the analysts expect the growth for SOFI to be in the next year? So they're actually expecting a 109% growth rate, which personally I think could definitely even be higher, as in the past they have had a surprise rate of, let me just find it, here it is, so anything from 20 to 638%. So it's clear that analysts are often underestimating the growth of SOFI. If we do use that 109% growth rate for SOFI, we can see here that the intrinsic value on the left is set at $25 with an acceptable buy price at 18, which is just barely above where we currently are. On the right, we can see the acceptable buy price is all the way down at $9, with the mean of these being at 14. This currently looks to be a sell if you do hold. However, if we do increase the growth rate for SOFI, let's see what happens. So increasing the year-over-year growth rate up to 150%, we can see that on the left we are currently at 25% on an acceptable buy price, and on the right in the bearish formula it is 12.95, with the mean of these being at 19, which is just barely above where we currently are. I think it's fair to say that SOFI stock is currently a hold. Of course, SOFI will have massive gains in the next couple of years, but for right now, I think it's definitely a hold, especially with the price to earnings being so high. I can't really suggest putting it at a buy right now, but with me saying that, I would like to just say that SOFI is still an amazing company, and I do think it will continue to grow for the next few years. So if you were to put money in it now, I don't think it'd be the worst decision ever if you were to hold it for long term. But for right now, if you're looking for a year's worth of growth, I don't think you will see too much return in SOFI. However, I could definitely be wrong, as this stock does tend to always beat the market either way. So AMD is a stock which could see a share of the market start to head into their favor in 2025. Despite this, the P ratio is still at 108 at the moment, with the earnings per share being at 1.13. This stock does look to currently be overvalued. However, that doesn't mean to say they won't see a lot of growth in 2025. If we see what the analysts are projecting for 2025, we are projected to see a growth rate of 54.16%. However, I do actually think this will be higher, as there is now going to be a large market shift into AMD, as their competitor NVDA can't seem to keep up with demand. A lot of consumers will start to head for AMD's products. Despite this, I have been very bearish on AMD in the past just due to the fact that their intrinsic value isn't very good. On the left here, we can see the intrinsic value at 164 with an acceptable buy price at 123. This gives us a buy rating. However, on the right, we have an acceptable buy price at 63, which when compared to the current price, this is almost half of where we currently are. So it prices us in at a sell currently. With the mean of these being at $93, this is actually still priced in at a sell. This is why I have been bearish on this in the past. This is actually taking into account a growth rate of 75%, which is higher than what the analysts are projecting. This is something which I personally put for AMD. So it is looking like a sell currently. However, I will actually be putting this at a buy, which I know could be very weird. I know this goes against my whole system, but I will be putting this at a buy in between HIMS and Google. If we quickly look to see where this stock actually is on a chart, we can see what position we're in. So we are currently in a short position, which is to be expected, but I think in the next couple of months we will see this reverse and we will see this turn into a buy. Of course, I have been very bearish on AMD in the past just due to the fact that their intrinsic value is so low and the PE ratio is so high, but it could definitely be a good stock in 2025 and beyond. Definitely beyond 2025 could still see a poor return for AMD stock, but I do think in the long term this is going to be a good stock to be buying. With the earnings report being set to come out on the 4th of February, if you are looking to hold this stock, do put that in your calendars as it will be a very important earnings for AMD. So now we are taking a look at PayPal. PayPal is up 37.56% on the year chart, with the P ratio currently being at 21 and the earnings per share being at 418. And analysts are expecting a 6.87% growth rate in the next year. Going off of this growth rate, we can see an acceptable buy price on the left here of 64 and on the right of 39, with the current price being at 89. This looks to be a strong sell. However, is that growth rate a relatively fair growth rate? If I increase that, say, to about 9, let's see what happens. So now I have increased it to 9, we're still seeing that we are massively in the red here. With the intrinsic value actually being set now at 101, we are still currently at an acceptable buy price at 76 on a more bullish chart. So for me, it's not looking too good for PayPal currently. So with that being said, I am going to put PayPal in at a sell. It could potentially be a hold for sure. It is only just barely overvalued in my mind, but it's hard to say. With competitors coming through, such as companies like SOFI, for example, in the fintech space, it's hard to see how PayPal can compete, and with the growth rate being so low, it's hard to say that this stock it's definitely not a buy, but it could potentially be a hold. But for the purpose of this video, I'm going to put it at a sell. So now we're going to be looking at Symbotics. I have been very bullish on Symbotics in the past and it did pay off. I got in around the bottom here of the last month and it did shoot massively up in the last few weeks due to a deal with Walmart. But with that being said, the earnings per share has now dropped to 0.14. But analysts are projecting a growth of 106% over the next year. Within my last video on Symbotics, we had an acceptable buy price of $47, giving us a return of 41%, and I do think we have seen that return now. So for that reason, I am actually going to now be putting Symbotics at a sell. I'm going to be putting it ahead of PayPal, but it's hard to say. Again, it could definitely be a hold, but for me, we'll leave it at hold actually, but it is close to a sell for sure. It's definitely not a stock to be buying into at the moment, as the intrinsic value has actually dropped significantly since their valuation has gone up in the market, as their earnings per share has dropped. But we could definitely see a lot of growth in this stock. In fact, we will definitely see a lot of growth in this stock, but currently it's looking to be fairly / overvalued. But if you are holding this stock, I would suggest to hold it still. I wouldn't actually put this in at a sell yet, despite the profits being it's starting to look like we have seen as much return as we expected to see within the year within Symbotics, as it went up around 36% in the last 2 weeks. So it's hard to say where you should be putting your money with this stock, but I will be placing this at a hold for now. So now looking at Supermicro Computer, we can see a PE ratio at 16.55 and an earnings per share at 201, with it being down 27% in the last year. What can we see on a growth rate for the next year? We can see a 32.81% estimate. Now, Supermicro Computer has been known to fabricate its reports previously, and it has definitely been something which has affected its stock. However, it will be interesting to see if they can prove truthful in the next couple quarters. So this is where it gets interesting for this company. On its intrinsic value here, we can see it's set at 136 on the left and 73 on the right, more bearish, with an acceptable buy price at 102 here and 55 on the right. We can see these are both priced in at a buy currently, which is a massive return if it was to be as truthful as this, which the system doesn't lie, it just uses the numbers, of course. It definitely looks to be that this stock is massively undervalued at the moment. And for that reason alone, and I do want to explain this, I will be putting this at a strong buy. I know, of course, it is a very risky stock. If you don't want to take a lot of risk, I wouldn't recommend it at all. But this stock does have high potential for returns in 2025. But of course, it could definitely go the other way, as this stock can be a bit suspicious at times. So we're now going to be taking a look at NVDA. So NVDA has a P ratio of 56 currently and an earnings per share of 2.54. With them being up 138% on the last year and 2,156 in the last 5. Analysts are still expecting a 50.59% growth in this stock. So what can we expect to see in this stock in the next year? Well, according to the intrinsic value on the left here, we can see it's currently set at 255, whilst on the right it is at 134, with an acceptable buy price on the left of 191 and on the right of 100. We can see that the current price being set at 142 sets this at a buy on the left and a sell on the right. If we go in between both of these values and take the mean, we can see that the acceptable buy price is 149, which is just barely above where we are now, and the intrinsic value is set at 194. So for that reason, I think this stock is fairly valued at the moment, but I do think it will definitely go up in value. As when we look at Peter Lynch's value, we are currently just barely overvalued, but this is very bearish, of course. So for that reason, I will be putting NVIDIA at a buy. I will actually be putting it above NVIDIA, above Google, sorry. I do think this stock is still really good. I still think you're going to see a lot of growth, and I do still think it's going to be AMD in percentage returned in 2025, just because of how dominant it is in its market. So with that being said, I'm going to end this video here. I hope this video has been useful and interesting. If it has, please do let me know what you think about these stocks in the comments. Please do leave a like, subscribe, and I will see you for the next video.